Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Everyone is looking at the Dow hovering near all-time highs, and they just assume everything is fine. But look, it's a complete illusion. This is what I call the great reassessment of 2026. If you actually peel back the top layer of shiny paint, the structural foundation of this economy is rotting. People tell me, Bob, look at the GDP, look at the job numbers. The Fed is pulling off a soft landing. No, absolutely not. We are looking at a massive divergence between nominal asset values, which are inflated by sheer momentum and debt, and the actual underlying physical and structural economic reality. It's a house of cards built on a swamp. The simple reality is that when you inflate the money supply by trillions, asset prices go up. But that is not real growth. That is nominal expansion. When you adjust for true inflation, when you look at the actual physical output per capita, we are stagnating. The consumer is completely maxed out. Corporations are staring at a massive refinancing wall, and yet the mainstream financial press wants to throw a parade because the S&P 500 hit another arbitrary milestone. It defies logic, or at least it defies honest economics. We've replaced sound productivity with financial engineering and government deficit spending, and we're calling it prosperity. Let's talk about valuations for a second, because this is where the math gets really, really ugly. The Shiller-Cape ratio, the cyclically adjusted price to earnings ratio, is currently sitting well above 35. Historically, the long-term median is around 16. The only times we've ever seen it this high were 1929 and the peak of the dot-com bubble in 2000. And people want to tell me, oh, Bob, it's different this time because of technology, because of productivity. It's never different. The math doesn't care about your narrative. And what's worse is the actual quality of these modern earnings. We're not talking about clean, organic cash flow growth here. We are talking about earnings that have been heavily manipulated through massive corporate share buybacks funded by cheap debt that was locked in back in 2020 and 2021. And now that cheap debt has to be rolled over at 5, 6, 7%. The earnings quality is deteriorating rapidly while the multiple is expanding. It is classic historical complacency right before the trapdoor opens. This brings us to the equity risk premium, or ERP. This is the extra return you expect to get for taking on the risk of owning volatile stocks instead of buying risk-free US Treasuries. Right now, because stock valuations are so stretched and bond yields are still elevated, the equity risk premium has compressed into negative territory. Think about how insane that is. You are literally getting paid less to own risky equities than you are to own risk-free government debt. It makes absolutely zero mathematical sense. But why is capital still flooding into stocks? It's pure herd behavior. It's FOMO, fear of missing out. People have been conditioned for 15 years to believe that stocks only go up and that the Fed will always step in to bail them out. So they ignore the risk-adjusted returns, they ignore the negative premium, and they keep piling into the same 5 or 6 mega cap tech stocks. It is systemic risk masquerading as a bull market. But what about the growth numbers? What about the headline GDP everyone uses as a shield? The media reports a 3% annualized growth rate, and everyone cheers. But if you actually look at the components of that GDP, it's not driven by private sector productivity or organic consumer demand. It is almost entirely driven by government deficit spending and inventory accumulation. The government is spending money like a drunken sailor, running a deficit of over 6% of GDP during a period of supposed economic expansion. We are literally borrowing from the future to buy the illusion of growth today. We are borrowing trillions of dollars from the future to buy current GDP growth today. It's a mirage. If you subtract the fiscal deficit from the GDP growth, the private sector is actually contracting. And we are servicing a $34+ trillion national debt at 5% interest. The interest expense alone is now eclipsing the defense budget. This is a structural drag that will eventually choke off any real organic economic growth. And then we have the labor market. Oh, the strong labor market. Every single month, the Bureau of Labor Statistics puts out this blockbuster establishment survey showing hundreds of thousands of new jobs, and everyone cheers. But then, quiet as a mouse, 2 months later, they quietly revise those numbers downward. We've seen consecutive months of massive downward revisions. It's a joke. They print a headline to pump the market and then bury the correction on a Friday afternoon. If you look at the household survey instead of the establishment survey, the picture is completely different. The household survey shows actual employment stagnation and contraction. Why the divergence? Because the establishment survey counts jobs, not people. If an average family has to take on 2 or 3 part-time gigs just to pay for groceries and rent because of inflation, the establishment survey sees that as 2 or 3 brand new, beautiful jobs. In reality, it's one exhausted worker struggling to survive. It's statistical manipulation at its absolute finest. When families are struggling to find secure full-time work, they do what anyone does to survive. They borrow. But the consumer is running on fumes. All that excess pandemic savings, completely gone, wiped out by 4 years of cumulative inflation. The personal savings rate has collapsed to near historic lows, hovering around 3%. Credit card balances have spiked to a record high, exceeding $1.1 trillion. When you're funding daily life with credit cards carrying 21% interest rates, you aren't strong, you are desperate. And look at the delinquency rates. Auto loan delinquencies and credit card delinquencies are not just rising, they are spiking, particularly among younger and lower income demographics. These are the subprime consumers, and they are the canary in the coal mine. They have exhausted their savings, they have maxed out their credit, and now they are starting to default. You cannot run a consumption-based economy on credit cards with 22% interest forever. The math simply does not work. Let's talk about the CPI. The official inflation rate is supposedly coming back down to 3%, right? But if you look at how they calculate it, especially the shelter component, which makes up over a third of the index, they use this ridiculous metric called owner's equivalent rent. It's essentially a survey where they ask homeowners, what do you think your house would rent for? It's completely subjective, and it lags real-world market rents and home prices by 12 to 18 months. In the real world, the cost of insurance, property taxes, maintenance, and utility bills has skyrocketed by 30, 40, sometimes 50% over the last 3 years. The average family is not experiencing 3% inflation. They are experiencing a permanent structural shift in their basic cost of living that is eating up every single dollar of disposable income. The official CPI is a statistical smoothing mechanism designed to keep Treasury indexing low and Social Security payouts suppressed. It is not real-world inflation. And that lag creates a massive blind spot for the financial sector. The regional banking system is quietly bleeding under the surface, despite the widespread assumption that the 2023 banking crisis was solved. The Fed's Bank Term Funding Program was just a temporary Band-Aid. Pledging underwater treasuries at par value to get short-term cash didn't make the fundamental losses disappear. The unrealized losses on investment securities held by U.S. banks are still sitting at over $500 billion. As long as the Fed keeps rates higher for longer, these banks are squeezed. They have to pay higher rates to depositors to prevent deposit flight, but they are stuck holding low-yielding assets. If we get another shock to the system, another sudden wave of panic, we could easily see a renewed deposit flight to the massive too-big-to-fail institutions. The regional banking sector is extremely fragile, and nobody wants to talk about it. And where do those banks hold most of their loan exposure? Commercial real estate. This is the shoe that has yet to fully drop, but it is dropping right now. Over the next couple of years, trillions of dollars of commercial real estate debt is set to mature. These loans were written 5 to 7 years ago at interest rates of 3 to 4%. Now they have to be refinanced at 8, 9, or 10%. And look at the valuations of those buildings, especially office space. With the permanent shift toward work from home and hybrid models, office vacancy rates in major cities like San Francisco, Chicago, and New York are at all-time highs. Some of these buildings are selling for 50 to 60% discounts compared to their pre-pandemic values. The owners can't afford to refinance at double the interest rate when their asset value is cut in half, so they are just going to hand the keys back to the banks. And who holds those loans? The regional banks. It's a slow-motion train wreck. The Federal Reserve is flying a modern jet plane using broken instruments from the 1970s. They rely on these outdated econometric models like the Phillips curve, which assumes a direct trade-off between unemployment and inflation. It has been disproven over and over again, yet they cling to it. And they consistently forget about the long and variable lags of monetary policy. It takes 12 to 18 months for a single rate hike to fully filter through the real economy. The Fed hiked rates at the fastest pace in history, and they think because the economy didn't immediately collapse, they successfully pulled off a soft landing. They are ignoring the lags. The full weight of those rate hikes is only now starting to hit the consumer and corporate refinancing schedules. The Fed is trapped. If they cut rates to save the banking system and the commercial real estate market, inflation will flare right back up. If they keep rates high to fight inflation, they will trigger a systemic financial collapse. They have no good options left. And then we have the Treasury supply issue. Because the federal government is running these massive multi-trillion-dollar deficits, the Treasury has to issue an absolute tsunami of new debt to fund the government. We're talking trillions of dollars of new supply hitting the market every single year. Who is going to buy all this debt? Historically, foreign central banks like Japan and China were the big buyers, but they are stepping back. They are dealing with their own domestic currency crises and are actually selling treasuries to defend their currencies. So if foreign buyers are stepping back and the Fed is supposedly doing quantitative tightening, the private market has to absorb all this supply. This crowds out private investment because capital is sucked into funding the government deficit instead of productive business enterprises. And it puts permanent upward pressure on long-term yields. The bond market is eventually going to revolt and demand much higher yields to fund this out-of-control spending, which will make the debt servicing costs even more catastrophic. Let's talk about corporate debt. For a decade of 0% interest rates, we saw the rise of what we call zombie firms. These are companies that do not generate enough cash flow to even cover their interest payments. They were kept alive solely by their ability to constantly issue new, cheap debt to pay off old debt. It was a Ponzi scheme of cheap capital. Well, that game is over. A massive amount of cheap corporate debt issued during the pandemic is maturing over the next 24 months. As these zombie firms and even relatively healthy mid-market companies are forced to refinance at current rates, their interest expenses are going to double or triple. This will completely destroy their corporate margins. To survive, they will have to cut costs. And what is the easiest cost to cut? Headcount. We're going to see a wave of corporate defaults and restructuring, followed by a significant spike in layoffs. The labor market lag is about to catch up with us. If you look globally, the situation is just as messy. The US dollar has remained incredibly strong, mostly because our interest rates are higher than almost everyone else's, and we are still seen as the primary safe haven. But a hyper-strong dollar is incredibly disruptive to the rest of the world. It makes dollar-denominated debt in emerging markets much harder to service, and it forces foreign central banks to burn through their foreign exchange reserves to protect their own currencies. Look at Europe and China. Europe is in a structural stagflationary trap, and China is dealing with a massive slow-motion property collapse that is destroying consumer confidence there. We're seeing a fragmentation of global supply chains as countries try to onshore or friendshore production. While that might make supply chains more resilient, it is structurally inflationary. The era of cheap globalized labor and cheap energy is dead, and that means structural inflation is here to stay, regardless of what the Fed's models say. The mainstream media loves nothing more than a consensus narrative. And right now, that narrative is the soft landing or even no landing scenario. But history is very clear on this. In 1989, 2000, and 2007, the consensus among economists was that the Fed had successfully steered the economy to a soft landing. In every single case, the soft landing narrative peaked right before we slid into a severe recession. It is a psychological coping mechanism of the markets. I'm watching very specific turning points that will signal the definitive transition to a hard landing. First, look at the yield curve. It has been deeply inverted for an extended period, and the actual pain usually starts when the curve rapidly de-inverts as short-term rates plunge in anticipation of Fed panic cuts. Second, watch the unemployment rate. Once it moves up by more than 0.5% from its cycle low, the Somme rule triggers. And historically, we have always entered a recession. We are right on the cusp of that happening now. Do not buy the hype. So, how do you navigate this? How do you survive the great reassessment of 2026? It's not about trying to chase the last 5 or 10% of momentum in an overvalued stock market. It's about strategic capital preservation. When valuations are completely detached from economic reality, the return of your capital is far more important than the return on your capital. This is a time for discipline, patience, and keeping your powder dry. I like high quality, short-term debt and treasury bills. You can yield over 5% completely risk-free while you wait for the market to correct. I also believe in holding hard, tangible assets, things that cannot be printed by central banks or inflated away by deficit spending. Real assets with actual utility. When the correction comes, and it always does, valuations will reset to historical norms. Having liquid cash and short-term paper will allow you to buy high-quality assets at deep discounts. Don't let the market herd drag you over the cliff. Stay disciplined, trust the math, and protect your capital. Talk soon.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.